Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Monday, June 5th, 2023, and this is our monthly market monologue. So let's just dive in. The first chart that we want to look at today is the monthly candle chart for the S&P 500. Again, every candle on the screen represents a different month in time. So this is the month of May, the month that just concluded. And I've labeled this chart as a month of indecision because you can see the candle is white, which means technically the market was up. The market as defined by the S&P 500. Technically the S&P 500 was up for the month of May, but not a whole lot of movement between the open and the close for the month. You can see there was some volatility in the middle of the month, but overall just barely closed higher than where it opened. So yes, the S&P 500 was indeed positive, barely, for the month of May. But let's dissect that a little bit further. And we're going to do that, one of the ways we're going to do that at least, is by looking at a tweet that was sent out by our friends over at Optima. Optima is the company that makes the software that we use on a regular basis. And so here we see that they're pointing out the S&P 500 was up 0.25% for the month of May. But then what they did is they broke down the S&P 500 into deciles. And so the top 50 stocks in the S&P 500 were up 1.13%. However, look at the bottom decile. The bottom 50 stocks in the S&P 500 were actually down almost 8% for the month of May. And this is the story that we have seen consistently for 2023. It is not just a handful of stocks. So it's more than just the top 4 or the top 5, but here we have the top 50 stocks in the S&P 500 that were positive for the month of May, whereas 450 of them were negative. Here we have the seasonality chart, which is showing us the average monthly performance for the S&P 500 since 1950. And as we just discussed, May 2023, the S&P 500 was positive 0.25%, which is just barely above the historical average. Now, look at the month of June. June, by historical standards, is not a very strong month. However, look at this blue dot here. We're already 2 days into the new month, and this is what we've already experienced so far. June has started out far better than historical averages. And what we're going to look at in just a few minutes is how we are starting to see some evidence that the character of the market may have changed. So we're going to come back to that thought, but let's take a look at the sectors of the S&P 500. Remember, there are 11 different sectors that make up the S&P 500, and on the screen here is the performance of these sectors for the month of May. Notice the zero line, the black horizontal line, and this, I don't even know what color that is, but that marks the S&P 500. So again, a rounding error, but that's the performance of the S&P 500 overall. Notice that there are only 3 sectors that had a positive month of May. All of the other sectors were negative. And you can see energy, the darling of 2022, continues to struggle, having a very bad month of May. Now, let's look at year to date. So the same chart, but this time we're going to look at the entire year. And again, here's the zero line. You see the S&P 500 is up approximately 9%, but that is driven by 3 different sectors. And I don't have it in my charts for us right now. Maybe before our next monthly market monologue, we can break this down. But even within these sectors, it is not the entire technology sector that is performing well. It is not the entire communication sector or an entire discretionary sector that is doing well. It's a very select handful of stocks within each of these sectors that are giving this dramatic divergence between the performance of these sectors versus the overall market. One more point that I will highlight, RSP. RSP is negative 1% for the year. That is the equal weight S&P 500. So again, the S&P 500 is cap weighted, which means the return is based upon, or how the average is calculated, it's based upon the market capitalization of the company. So a really big cap stock like Apple has a greater influence on the performance of the overall sector. Well, the equal weight RSP measures or values, if you will, every stock within the S&P 500 the same or equally. And so you can see there's a big difference between the cap-weighted index and the equal-weighted index. And again, this is what we're seeing fairly consistently so far this year, but we may have started to see some character change. We'll look at that in just a second. To further illustrate the divergence between those that are performing and the massive number that are not performing well year to date, let's look at a couple other indices. On the screen we have the S&P 500, which we've already discussed. It is up approximately 9.3% through the month of May. If we then add into the mix the Dow Jones Industrial Average, we see that average is negative 0.7 through the month of May. Next, we will add small caps. The small cap sector, which we're going to talk a little bit more about, is positive barely 0.21% for the year. Next, we'll add in the New York Stock Exchange Composite. So all the stocks that are traded on the New York Stock Exchange, that is negative 1.7% for the year. Again, you're starting to see the divergence between this S&P 500 and some of these other indices. Next, we'll throw in the All-World Index, ex-US. In other words, this is trying to measure all the stock markets throughout the world without so in other words, you remove the United States stock market from that index, and that is up about 4.4% year to date. Next, we are going to add in the NASDAQ, and here is the massive divergence of what we have seen in the tech sector. Again, as we've discussed, it is not the entire tech sector, but the NASDAQ is also cap weighted. So we're seeing a segment of this tech sector that is performing really, really well, which is pushing that index to the top spot for the year to date. We'll add in a couple of bond sectors. We see TLT just got added into the mixture. We're seeing long-term bonds are positive about 1.5% year to date. And then AGG, which is positive 1% for the year. So trying to really highlight the divergence between these top two sectors, the S&P, or not sectors, but the top two indices, the S&P 500 and the NASDAQ. They're really throwing some shade on the other indices, but what we're really trying to highlight is the fact that not everybody, not every sector, not every stock is participating in this year's advance, but we are starting to see some character change. And so let's talk about that now. These next couple of slides are what we refer to as participation. So in the top pane of this chart is the S&P 500. Then this pane here is the percent of the S&P 500 that is above the 20-day simple moving average. This middle pane here is the percentage above the S&P 500 that is above the 50-day moving average. And then the bottom one is the percent of the S&P 500 that is above the 200-day moving average. And we're going to show you the same chart for the Russell 3000 in just a minute. The Russell 3000 is capturing about 97, I believe, about 97% of the United States stock market. So the problem, one of the problems with the S&P 500 is it is really only measuring the large cap or the big companies. The Russell 3000 is going to get us a better understanding of what's actually happening across the United States stock market. Now, the last thing that I'll highlight is you're going to see the format of these charts change just a little bit, because I was actually at the beach with my family on the first day of the month. And so I wanted to look at this data, but I was only on my laptop, and so that's why the formatting is a little bit different. I'm going to show you how this changed from the end of the month of May to the end of the week. So just 2 days in June, and we see a character change. So this is what it looked like at the end of May. Now, after the end of Friday, June 2nd, we see a change. Okay, now to really highlight this, let me show it to you this way. The inset here is what it looked like at the end of May. And you see that on the May 31st, we had about 35% of the S&P 500 was trading above its 20-day moving average. 2 days later, June 2nd, we see that it has jumped quite significantly from 35.5% to 63%. That is a large change in the character or the participation of the stock market's advance. Now, the 50-day moving average in 2 days. So May 31st, it was 33%. 2 days later, it was almost 51%. And then the 200-day moving average. Remember, the 200-day moving average is the indicator that we look at to determine if a stock or an index is in an uptrend or a downtrend. So in order for us to be confident that we're in a really good, strong bull market, we need to see a lot or a high percentage of these indices that are trading above their 200-day moving average. Because if they're trading below the 200-day moving average, that stock or index is technically in a downtrend. So the 200-day moving average is really important. And again, May 31st, we had just about 40% of the S&P 500 trading above the 200-day moving average. 2 days later, it's up to 49%. That's a very strong move. Now let's switch gears. This is what I really started looking at on a more regular basis, because this is doing a better job of looking at the overall United States stock market. Again, this is the Russell 3000 in this top pane, and this first screen is what it looked like on my laptop while I'm sitting at the beach on the evening of the 31st. And so then again, the 20-day moving average, the 50-day moving average, and the 200-day moving average. And I really want you to see this red line. This is a negative trend line that is on the 200-day moving average, or the stocks that are participating that are above the 200-day moving average. Now, 2 days later, how did this change? You can see these spikes. And you see down here, again, I've drawn this trend line on the percent of the Russell 3000 that is above the 200-day moving average. This is a negative trend. It's going to slope is downwards, but you can see Thursday and Friday, that trend got broken, which is a very good sign. But let's now put it in contrast. On May 31st, 48% of the Russell 3000 was trading above the 20-day moving average. 2 days later, it's up to 72.5. That is a massive change in character. That is a very good sign. Now, the 50-day moving average, 42% at the end of May. 2 days later, it jumped to 59%. And then the 200-day moving average, 37%, or approximately 37% at the end of May. 2 days later, we're up to 44%. So that is a very good indication that we're finally starting to get some participation in these smaller companies. So that is a very good sign. Now, let's look at one more thing. And this is the advanced decline line. Okay, again, in the top pane, we have the IWV, which is the Russell 3000, and then we have the advanced decline line. And again, I'm going to show you the difference. This is what it looked like on May 31st in the evening after the month of May has closed. I'm going to show you what it looked like 2 days later after June 2nd. So just as a refresher, the advanced decline line is showing us a cumulative total of the number of stocks that are advancing minus the number of stocks that are declining. So when we have more advancing stocks than declining stocks, the line moves up. When we have more stocks that are declining than are advancing, the line's going to move down. At the end of 2021, going into 2022, we were highlighting this divergence. The indexes, the S&P 500 and the Russell 3000, they were still moving up. This point to this point, there's an increase here. However, more stocks were declining. And so this trend here is up versus this trend here is down. That's a bearish divergence. And that helped us or forewarned us about troubling times ahead. Now, fast forward to today, and we see we can draw a flat horizontal line from the high of 2023 to the basically the close of the month of May. But you see this negative trend in the advanced decline line. That is the concern. 2 days later, we see that we got the Russell 3000 popped out. We also see that this downtrend has been broken. So there's still a lot more work to be done, but this is a very good sign. So we'll land the plane here on that positive note. This year has been very interesting so far, with a handful of stocks within a handful of industries that have been performing well, while the average stock has been languishing. However, this past Friday, we definitely saw some encouraging signs, and the character of this stock market may very well be changing for the better. So stay tuned in that regard. That said, we hope you find these videos helpful. If so, please hit the like button here on YouTube and leave us a positive comment. We do read all of your feedback. We love it. And by all means, feel free to share our content with others. We have the office here in Cary, North Carolina, as well as in Southern Pines, North Carolina. But in today's digital world, we serve clients in a proactive manner all across the country. So if you would like more information about how we might be able to serve you and your wealth management needs, by all means, feel free to reach out to us. You can find our contact information at Hicks-Associates.com. Until next time, thanks for watching.